Two people started with the exact same amount of money, same age, same job, same city. 25 years later, one of them was a millionaire, the other one was still renting an apartment. One of them bought houses, the other one bought stocks. And today, I'm going to show you exactly what happened to their money, year by year, dollar by dollar. But here's the part that will surprise you. The winner wasn't decided by which asset was better. It was decided by something almost nobody talks about. Most people think this is simple. Real estate always wins, or stocks always win. Pick a side, argue online, done. But almost nobody actually runs the numbers, real numbers, over real years with real costs included. So today, we're doing exactly that. Two people, 25 years, $1 amount to start. Let's meet them. Meet Alex, 25 years old, works in sales, just saved up $20,000. Alex believes in one thing, property. Meet Jordan, also 25, works in marketing, also has $20,000 saved. Jordan believes in something else, the stock market. Same starting line, same starting money, completely different paths. Let's follow both of them, starting today, year one. Here's what Alex does. Instead of buying a house with cash, Alex uses something called leverage. That just means using the bank's money along with your own. Alex takes that $20,000 and uses it as a 20% down payment on a $100,000 rental house. The bank covers the other $80,000. This is the magic of real estate. Alex now controls a $100,000 asset using only $20,000 of his own money. Alex rents the house out. Tenants pay $800 a month. That money covers the mortgage, the insurance, and the property taxes. But renting out a house isn't free money. There are real costs. Repairs, vacancies, property management. Let's be honest about all of them. On average, real estate investors spend about 1% of the home's value every year on maintenance. On a $100,000 house, that's $1,000 a year. After the mortgage, insurance, taxes, and repairs, Alex is left with about $200 a month in actual profit. That's $2,400 a year. But that's not the real win. The real win is what happens to the house itself, because houses tend to go up in value over time. Historically, houses in America have appreciated around 4% per year. That sounds small, but watch what 4% does over 25 years. Now let's look at Jordan. Jordan does something completely different. No houses, no tenants, no repairs. Just one simple move. Jordan takes the $20,000 and puts all of it into something called an index fund. Specifically, a fund that follows the S&P 500. Here's what that actually means. An index fund is a single investment that owns tiny pieces of 500 of the biggest companies in America, all at once. That means Jordan doesn't have to guess which single company will win. Jordan owns a small slice of all of them at the same time. No tenants to manage, no toilets to fix, no 2 a.m. phone calls about a broken pipe. Jordan just checks an app once in a while. On top of that, Jordan adds $500 every single month into the same fund, rain or shine, no matter what the news says. Historically, the stock market has returned about 10% per year on average, including the good years and the terrible years. But stocks don't move in a straight line. Some years it's up 20%, some years it's down 30%. That's the price of the higher average. Real estate feels stable because you don't see the price every day. Stocks feel scary because you see the price every single second. That difference in feeling is exactly why most people quit stocks too early, and why most people never even start with real estate. Alright, rules are set. Now let's fast forward. Let's watch what happens to Alex and Jordan's money year after year, starting now. Year 1. Alex's house is worth $104,000. After paying off a little bit of the loan, Alex's equity is about $25,000.
Year 1. Jordan's $20,000 plus 12 months of $500 deposits has grown to about $28,000. After year 1, it's close. Jordan is actually slightly ahead, $28,000 versus $25,000. But this is only the beginning. Year 3. Alex uses the growing equity in the house to take out a small loan and buy a second rental property. This is called using equity to scale. Alex now owns 2 properties, both slowly paying themselves off through rent, both slowly rising in value. Year 3, Jordan keeps it simple. Same fund, same $500 a month. No changes, no new decisions to make. Year 5, Alex's 2 properties are now worth a combined $243,000. Equity after the loans, about $70,000. Year 5, Jordan's account has grown to about $52,000, thanks to compounding and consistent monthly deposits. At year 5, Alex is ahead, 70,000 versus 52,000. The leverage is starting to show its power. But leverage cuts both ways. That same year, Alex loses a tenant for 3 months. No rent coming in, but the mortgage still has to be paid. Alex has to dip into savings to cover it. This is the hidden side of real estate that most people never mention. Meanwhile, that same year, the stock market drops 18%. Jordan's account value falls on paper. It's scary to watch. Here's the key decision point. Jordan does not sell. Jordan keeps depositing the same $500, even during the drop. This single decision, staying calm during a crash, will matter more than almost anything else in this entire story. Year 10, let's check in. Alex's 2 properties have grown in value, and Alex just bought a 3rd property using equity again. Alex's 3 properties are now worth a combined $450,000. After the loans, Alex's real equity is about $160,000. Year 10, Jordan's index fund, boosted by 10 years of compounding and monthly deposits, has grown to about $118,000. Alex is still ahead, $160,000 versus $118,000. But notice something important happening to Jordan's curve. This is compound interest starting to accelerate. In the early years, it looks slow. In the later years, it explodes. Meanwhile, Alex hits a wall. The bank won't approve any more loans. Alex has too much debt already. No more properties for now. This is the ceiling of leverage. At some point, banks stop lending, and your growth slows down unless you save up more cash. Jordan has no ceiling like this. There's no bank approval needed to buy more of an index fund. Just click a button and invest. Year 15, Alex's 3 properties, now more valuable, are worth a combined $610,000. Equity has grown to about $280,000. Year 15, Jordan's fund has grown to about $260,000. The gap between them is shrinking fast. $280,000 versus $260,000, almost tied, and Jordan hasn't fixed a single toilet. That same year, one of Alex's tenants stops paying rent completely. It takes 4 months and a legal process to remove them. It cost Alex nearly $6,000 in lost rent and legal fees. This is the stress that never shows up in the profit charts. Jordan, meanwhile, spends 15 minutes a year checking her account. That's it. No tenants, no legal fees, no stress. Year 20. This is where things get really interesting. Let's look at both numbers side by side. Alex's 3 properties are now worth a combined $820,000. After paying down the loan significantly, equity is about $460,000. Year 20. Jordan's fund, powered by 20 years of 10% average growth and steady deposits, has grown to about $510,000. Wait, Jordan just passed Alex. $510,000 versus $460,000. The stock investor is now ahead.
How did this happen? 2 words, compounding and simplicity. Jordan never stopped. Jordan never got stressed out of the game. Jordan just kept going. Alex's leverage was powerful early on, but debt payments, repairs, vacancies, and legal fees quietly ate away at the advantage. This doesn't mean real estate is bad. It means real estate has hidden costs that most people forget to count. Year 25, the finish line. Let's see the final numbers for both Alex and Jordan. Alex's 3 rental properties are now worth a combined $990,000. After finally paying off most of the loans, Alex's total equity is about $650,000. On top of that, Alex has been collecting growing rental income every single month, which by now adds up to roughly $2,000 a month in extra cash flow. Year 25, Jordan's index fund, after 25 years of consistent investing, has grown to approximately $940,000. So here's the final scoreboard. Alex, $650,000 in equity, plus $2,000 a month in rental income. Jordan, $940,000, fully liquid. On paper, Jordan's number looks bigger, but Alex has something Jordan doesn't: real monthly cash flow and a paid-down asset that keeps paying him. If you add Alex's rental income over the next 10 years to his net worth, the 2 paths end up almost exactly even. So who actually won? Here's the truth most finance channels won't tell you. The asset almost didn't matter. What actually mattered was this: both Alex and Jordan did one simple thing for 25 years straight. They kept investing, no matter what. They never stopped. They never panicked. They never spent the money on things that didn't grow. That consistency is the real secret. Now think about the person who does neither. No house, no stocks, no plan, just spends whatever comes in. Let's see what happens to that person. 25 years later, that person has close to nothing saved. Not because they earned less. Alex and Jordan didn't earn more money than this person. They just did something with it. This is the actual lesson hiding inside this whole story. It was never about houses versus stocks. It was about doing versus not doing. Real estate rewards people who can handle debt, stress, and hands-on problems, in exchange for leverage and monthly cash flow. Stocks reward people who can stay patient, stay calm during drops, and keep adding money without needing to manage anything. Neither path is wrong. The only wrong path is the one where you do nothing and hope things work out on their own.
So what should you actually do with this information? Let's break it down simply based on your own personality. If you enjoy hands-on projects, don't mind dealing with people, and want monthly income now, real estate might fit you well. If you want something simple, low stress, and fully automatic, index funds are one of the most powerful tools ever created for regular people. And here's a secret: you don't actually have to choose only one. Many wealthy people do both at the same time. The real starting point isn't picking the perfect asset. It's starting with whatever amount you have, even if it's small. Alex and Jordan didn't start with a lot, $20,000 each. What made the difference was 25 years of not quitting. If you're starting today with far less than $20,000, that's completely fine. Time matters more than the starting amount. A 25-year-old who invests $100 a month will likely end up with more money than a 45-year-old who invests $1,000 a month. That's the power of time in the market. It rewards people who start early far more than it rewards people who start big. Let's go back to the question we started with. One bought houses, one bought stocks. Who actually won? The honest answer is they both won, because they both did the one thing that 90% of people never do. They started and they never stopped. The real loser in this story was never the stock market or the housing market. It was the person on the sidelines who never got in the game at all. The difference wasn't income. It wasn't luck. It wasn't even the asset they chose. The difference was behavior, repeated for 25 years. So the real question isn't houses or stocks. The real question is, 25 years from now, will you be the one telling this story or the one watching it happen to someone else? If this video helped you understand money a little better, hit subscribe. WealthCat breaks down real financial strategies like this every single week. Drop a comment below. Would you rather be Alex or Jordan? Let's see which side wins in the comments. And if you want to see exactly how much one small habit can grow over time, watch this video next.